Two men, same $50,000, same goal, income they can count on. Ray, 61 from Georgia, did his homework. He found a high-yield fund paying 11%, big names behind it, monthly checks hitting his account like clockwork. He felt smart because everyone else was stuck earning 4. Linda, 59 from Michigan, did the boring thing, a plain index fund, no special yield, no clever structure, the kind of investment people call lazy at dinner parties. Same starting money, same 3 years. Linda walked away with over $20,000 more than Ray. And here's the part that makes this sting. On Ray's statement, everything looked perfect, every single month, right up until it didn't. So what happened? 5 things were hiding inside that 11%. Not one of them was in the brochure. And by the end of this video, you'll know all 5, so you can spot them in anything you own or anything someone tries to sell you. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. The first thing hiding inside that 11% starts before a single dollar of interest is even earned. Myth 1. The fees are just the management fee. Here's the myth. You look at a high-yield fund and you see a management fee of 1.5%, maybe 2. That feels fine. Plenty of funds charge that. No big deal. Here's the truth. That number on the brochure is just the front door. Behind it sit 2 more fees most investors never count. The first one is the incentive fee. This is money the fund manager earns on top of the management fee, usually 17 to 20% of every dollar they make above a certain hurdle. Sounds fair on paper, but Morningstar did the math and found something that should bother you. Once these funds use leverage, and almost all of them do, clearing that hurdle becomes, and I'm quoting their exact language, a virtual guarantee. The incentive fee stops being a reward for good performance. It becomes a second management fee that shows up every single quarter no matter what. Now add in the cost of the leverage itself, the borrowing, the overhead. When you stack it all together, the average public high-yield fund charges around 5.1% per year, all in. Let that land for a second. The boring index fund, VOO, charges 0.03%. That's $3 on every $10,000 you invest. The high yield fund, that's $510. Before your fund earns you a single cent, it pays itself 170 times what the boring fund charges. Think about what that means over 10 years on $200,000. The index fund costs you about $600 total. The high yield fund takes over $100,000 in fees. That's not a rounding error. That's a second car. That's 2 years of retirement expenses. Gone. To the manager, not to you. But here's the thing, the fees are just the first crack. The second one is hiding inside the income itself, in the part your statement never explains. Myth 2, that 11% yield is all real cash. Here's the myth. You see 11% on the brochure. You assume that means the companies borrowing money from your fund are paying 11% in real cash interest, every quarter like clockwork. Here's the truth. Some of them are not paying cash at all. When a borrower hits a rough patch, sales slow, costs climb, and they can't make their interest payment, the fund does something quiet. Instead of calling it a missed payment, they let the borrower add what they owe onto the top of the existing loan. The balance grows, but no cash changes hands. Wall Street has a polite name for this. They call it payment in kind, PIC. Let me take Wall Street out of it. Imagine you own a rental property. Your tenant comes to you and says they can't make rent. Instead of calling it what it is, a missed payment, you say, just add it to what you owe me. Then at the end of the month, you write that unpaid rent down as income you earned. And then you take money out of your own pocket and hand it to your family as if the tenant had really paid. That is what is happening inside some of these funds right now. At Prospect Capital, 35% of their investments carry PIC. At FSKKR, it's 27%. At Blackstone Secured Lending, 20%. And it gets worse, because funds like these are legally required to distribute at least 90% of their reported income. So even when the income is phantom, when it was never collected in cash, they still have to mail you a check as if it were real. One fund, Blue Owl Technology Income Corp, returned 35% of investors' own money back to them in early 2026. They labeled it income. It was not income. It was your own cash coming back to you with a different name on it. Here's a question we're sitting with. If a chunk of your yield was never earned in cash, what exactly are you being paid with? Before I show you what happens when investors try to leave, drop a comment right now. Are you holding any high-yield funds or have you been tempted by one? I read every single comment. Now, imagine you see all of this and decide you want out. Here's where the real trap snaps shut. Myth 3. I can sell whenever I want. Here's the myth. You figure these funds are like anything else. If you don't like what you see, you sell, move on, get your money, and walk away. Here's the truth. Many of these funds have a gate, a limit on how much money can leave in any given quarter. The common cap is 5%. When things are calm, you'll never notice it. You could own one for years and never know it existed. But that gate has exactly one job, and it only does that job at the worst possible moment, when everyone tries to leave at the same time. In the first quarter of 2026, the 12 largest non-traded high-yield funds received redemption requests averaging 12.1%, more than double what the gate allows. They honored just 53.4% of those requests. Nearly half the people who wanted out were told no. At one fund, Blue Owl Technology Income Corp, 40.7% of investors asked for their money back. Only 5% could leave. And that's not the worst of it. Blue Owl permanently shut redemptions on a separate $1.6 billion fund. Permanently. The door didn't just crack, it closed. In real estate, Blackstone's BREIT locked investors out for 16 straight months. 16. If you needed that money during those months, it simply did not exist for you. The Safe, Steady Income Fund turns out to have a fire exit that only opens a crack, and the line forms fastest exactly when you most need to get through. Smart investors understand something most miss. Liquidity isn't a feature, it's a promise, and promises break under pressure. And even if you do get out, there's one more cost nobody calculates until the tax bill shows up.
Myth 4. At least the tax hit is the same. Here's the myth. Income is income. Whether it comes from a high-yield fund or an index fund, the IRS treats it the same. Here's the truth. The IRS treats them completely differently, and the difference can cost you thousands of dollars every single year in retirement. The boring index fund pays qualified dividends. Those are taxed at 15% for most retirees. Some pay 0. High-yield funds pay ordinary income. That's taxed at your regular rate. For many retirees, that's 22 or 24%. It can go as high as 37. On a $500,000 position, that gap in tax rates alone is worth thousands of dollars a year, every single year. But here's where it gets really expensive, and this is the part almost nobody talks about. Those high-yield distributions inflate your adjusted gross income, and for retirees on Medicare, that number controls something called IRMA. It stands for Income-Related Monthly Adjustment Amount. In plain English, it's a surcharge on your Medicare premiums. The thresholds are cliffs, not slopes, cliffs. In 2026, if a married couple's income crosses $218,000 by even $1, they pay an extra $2,297 per year in Medicare premiums. That surcharge repeats every single year, and Medicare uses your income from 2 years ago, so by the time you see the damage, it's already locked in. A retiree chasing 10% yield on $300,000 could push themselves right over that cliff, not because they earned more, but because the tax code counted their income differently. And one more thing nobody mentions. Those return of capital distributions we talked about earlier, the ones where the fund hands you back your own money, they reduce your cost basis, which means the day you finally sell, your capital gains bill is bigger than you ever expected. The tax doesn't disappear, it waits. So those are the 4 cracks hiding inside that yield. Now let's put both investors side by side, dollar for dollar. At the end of 3 years, Ray's $50,000 grew to about $57,800, a 16% total return. Not nothing, but hold that number. Linda, same $50,000, the boring index fund, no special yield, no clever structure, no monthly checks to brag about. Her $50,000 grew to about $78,300, a 57% total return. Read those two numbers one more time. Ray, who reached for 11%, about $57,800. Linda, who settled for boring, about $78,300. The person who chased the highest yield in the room finished more than $20,000 behind the person who refused to chase anything at all. And if you think that's a one-time fluke, here's the number that should end the argument. There's a fund that tracks mortgage REITs. It's called REM. It has yielded roughly 10% every year since it launched in 2007, nearly 2 decades of double-digit yield. And its total return, with all those dividends counted, has been negative, minus 1.37% per year for 19 years. Investors who chased that 10% yield didn't just underperform, they actually lost money, while the S&P 500 more than quadrupled. The academic research confirms it. The highest yielding group of dividend stocks consistently underperforms the second highest group. The very top of the yield ladder is where the worst outcomes live. And the SBIVA scorecard, which tracks active managers against their benchmarks, over 15 years, there is not a single category, not one, where a majority of active managers beat the index. The yield was never the reward. The yield was the warning label, written in the only language money speaks. Boring doesn't mean bad. Boring means nothing is hiding. What do smart retirees do instead? So, what do you do with all of this?
If you own a high-yield fund right now, or you're looking at one, there are 3 numbers you check before anything else. Number 1, what percentage of the fund's income is PIK, payment in kind, the paper interest that was never collected in cash? If that number is above 10%, something is wrong. At Prospect Capital, it's above 15%. At FSKKR, it's above 13%. That's not income. That's an IOU dressed up in a suit. Number 2, what's the price compared to the fund's stated value? If the fund says its assets are worth $19 a share, but the market only pays $9.50, that's a 50% discount. The market is telling you out loud that the stated value is not real. FSKKR trades at 50 cents on the dollar. Prospect trades at 44 cents. When the market disagrees with the fund's own math by that much, believe the market. Number 3. Are any recent distributions labeled return of capital? Because that's not income. That's your own money being handed back to you. And every dollar of return of capital lowers your cost basis, which means a bigger tax bill the day you sell. There is one fund that passes all 3 tests, Main Street Capital. It's internally managed, which means lower fees. It has returned about 16.7% per year over the past decade. It actually beat the S&P 500. But it's nearly the only one. Out of dozens of public high-yield funds, one clears the bar. That tells you everything about the odds. For everyone else, the answer is the same one Linda found 3 years ago, the boring fund. It earned what it earned, it paid what it had. No phantom income, no locked exits, no surprise tax bills. Ray didn't make a dumb decision. He made the decision almost everyone makes. He saw 2 numbers, 11 and 4, and assumed the bigger one meant more money. But a yield that high is never a gift sitting on the table. It's a question. What has to be true for this to keep working? And if you can't answer that question with real numbers, the yield isn't yours. It belongs to the risk you didn't see. If someone you care about is chasing high yield right now, share this video with them. It could save them more than $20,000. Drop a comment and tell me, what's the highest yield you've ever been tempted by? And after watching this, would you still take it? If you want to stay ahead of traps like this and build retirement income you can actually count on, subscribe to this channel. I break down everything that protects your money, so you see it before it shows up on your statement. And in the next video, I'll show you the 3 ETFs that actually deliver what high-yield funds promise, without any of the traps we just uncovered, because bad math doesn't disappear. It just waits.